Ladies and gentlemen, welcome to the Warrior Enigma. On today's episode, I get the honor to sit with my good friend and financial guru, Mr. B.D. Collins, and talk about his book, $1,000 to $1 million, Proven Strategies for Triple Leveraged ETF Success. This is the very same book I begin every show speaking about. Brandon has been a massive supporter of not only the Warrior Enigma, but of me throughout my entire adult life. With the current political climate directly affecting the stock market, it was important for us to sit down and talk about investment options for listeners to expand their current knowledge base. As Brandon states in the show, volatility is a synonym for opportunity. Well, if you haven't been paying attention, there's a lot of opportunity in the market right now. Listen along as we talk about his book and how his strategy can be used in a hypothetical reflection of today's market. He answers questions such as, what is an ETF? We cover price to earnings ratios and how those may be skewed metric to value a stock. And one of my favorite parts, Brandon makes a football analogy that beautifully explains the thought process behind investments and how it is important to have a game plan. As with anything in life, you can expect to have hiccups along the way. This episode is no different. As I learned to record and produce episodes, hiccups inevitably happen. Due to unknown reasons, Brandon and I lost audio 45 minutes into our hour-long show, and this episode ends very suddenly. I apologize for losing the last 15 minutes and the wrap-up of the segment, but the information gathered is just too good to scrap. Learning curves be damned, and in line with the resiliency I strive to encourage in listeners, I'm going to send it anyways, so enjoy. All right, guys, welcome to Warrior Enigma. We're doing a quick little episode today. It's kind of a specialty episode. I'm sitting here with my good friend, Brandon. Brandon wrote the book that I talked to you guys about on every intro to our show. B.D. Collins, he wrote the 1,000 to 1 million proven strategies for triple leveraged ETF success. The reason today is a special episode and we wanted to get it out, we've been meaning to sit down and talk to each other for a while, but the market has been doing some crazy stuff. The new administration, there's a lot of questions going around financially. So I wanted to sit down with Brandon here, make sure that I'm on the same page. I want to reiterate for you guys, Warrior Enigma is not an advice-giving platform. We're simply providing information. So nothing we're going to talk about today. Brandon obviously wrote a very fantastic book about it. I was just talking to him about it. I'm on my second time through it, and I already know I'm going to have to go through for a third time. A lot of information in here, but we're not telling you what to do with your money. It's simply information that has worked. There's metrics, there's science behind it. There's a lot of things that Brandon and I are about to talk about that say this is a very good strategy, but what you do with your money is on your dime. So make smart decisions, use the information wisely. That being said, Brandon, dude, thanks for coming on.
Yeah, absolutely. Good to be here.
This book, once again, there's a lot of information in here. So if you don't mind, in your words, what's a quick summary of $1,000 to $1 million proven strategies for triple leveraged ETF success? The name itself, there's a lot of information there. So you wrote the book, man. Quick little synopsis. What do we got here in my hands?
Yeah, so the idea came from a beginning concept of a lot of us have very limited capital that we can work with in investment strategies. So I kind of reversed engineer an idea where how would you get from point A to point B with limited capital? So I started from the goal center, right? And then from the goal center, I would say, okay, well, if the overall encompassing goal is to reach millionaire status, right, which is a lot of what we're trying to achieve in life, depending on what your goals are, if it's trying to reach a millionaire status, how could you do that with limited capital? Well, the obvious idea would be that you have an original idea that you built from scratch, right? We might call that a startup. But another concept, and the concept that I ascribed to mostly, was investment strategy, right? So that's where my schooling is. It's investment strategy. That's where my apprenticeship comes from, is technical analysis. So I said, okay, we have the goal in mind. We have the framework. We're going to use limited capital, 1,000. We're going to try and achieve that with $1 million. Is it conceivable, possible inside of a limited time period? So you run the math, right? And you basically come up with this idea. If you take your 1,000, which is your desired balance, so we'll call that our ending balance, and then you divide that by your starting balance. So you have 1 million divided by 1,000. And then you take that to the power of 1 divided by your time, right? And then you subtract to 1. It will tell you what your compound annual growth rate to actually achieve in that period of time is. I came up with 38%. which means if you want to do this and that, roughly 38%, give or take. But if you want to achieve 1,000 to 1 million, you would essentially have to do it with this CAGR, compound annual growth rate, right? So with that, you start to develop a trading strategy. And the problem with trying to achieve excessively high compound annual growth rates, especially when compared to like benchmark indexes like the S&P, which is what we generally frame CAGRs against at 12.5% per annual, is you run into risk and excessive volatility.
Right.
Okay. So how can you build a system that can get you to achieve your financial goals, but limit your risk at the exact same time? So those are somewhat of a paradox inside of the investment community.
Right. That's like Wonka's golden ticket.
Exactly. Exactly. So anyway, I had the goal in mind. I had the educational structure inside of my head, my technical analysis background. What I didn't have is a concept to know if it was actually achievable inside a reasonable time frame. Books exist on various different investment strategies and stuff like that. And what I was discovering as you go through all of these, Benjamin Graham security analysis, various different other ones, start you out at a capital of $10,000. And they run you over a time horizon of approximately 20, 30, 40, 50 years. Well, who invests for that long?
Right.
Who invests for in excess of 20 years?
Right.
So I had to do two things. I had to use limited capital, and I had to use a lower time horizon. So then I just started working backwards. Highly complex instruments, triple leverage ETFs, that solves my volatility problem.
Can we pause right there for a sec?
Yeah.
Triple leverage ETFs. Now, I'm slightly familiar with the market, so I came from a baseline where I knew what an ETF was. But can you please, for people who aren't tracking the ETF side of this investment strategy, what is an ETF and how is it put together? Like, what does that mean for the everyday investor?
That's an excellent question because, yeah, you're absolutely right. You need to understand what an ETF is before you start investing in it. And so what an ETF is it's basically a basket of various different instruments. And the instruments could be almost anything that's inside of the ETF. And so the ETF provides the frame for everything that's inside of it. And everything that's inside of that ETF, that instrument, we'll call it a stock, for instance, just to make it simple.
Because those instruments can be housing, it can be
yeah.
stocks, it can be any financial institution can be a part of this, right?
Yeah, precisely. So your stock would be your instrument, and the ETF is going to be the vehicle that it operates with. So, for instance, you can have an S&P 500 ETF, and it really just tracks in a 1-to-1 ratio the exact movement of the S&P 500 index. But you could also have them more specific. So, for instance, you could have an ETF that is just the Magnificent Seven. There's a Mag 7 ETF. And what, Facebook, Google, and NVIDIA and all those ones move, that ETF moves. The interesting thing is that where it started out in the very beginning with State Street's SPY, the S&P 500, it just completely morphed into something where now you have these ETF derivatives that are they're ETF multipliers, right? So you have S&P 500, all of the S&P 500 stocks, right, are inside of that, and the ETF tracks that. Okay, so there's your instrument. Well, you have limited volatility with the S&P 500 because it's so diluted, it's highly diversified. You do that by increasing leverage. So now you have 2 and 3 times moving ETFs. That's the derivative, right? So hundreds and hundreds of ETFs, various different reasons behind them. You even have inverse ETFs, ETFs that move up when things move down. They have opposite effects.
Calls and puts style.
Calls and puts.
Yeah.
Yeah. You have dividend ETFs, ETFs that invest in stocks that use high dividend returns or even use call and put sale options, just like you mentioned, for income generation. So an ETF, in its basic defined term, is a basket of investments, and what's inside of that investments, that basket defines that ETF and how it's structured.
And you chose to use predominantly the TQQQ, right? Or does this
100%.
So throughout your book, you mentioned that one specifically, holistically. But this is a ETF success. This strategy works for any ETF.
The strategy absolutely works for any ETF. I picked the TQQQ for a very specific reason. The NASDAQ of the 3 indexes, which you have your Dow, your S&P 500, and your NASDAQ, and we're going to exclude the Russell, right? So those are three primaries. Of those, the NASDAQ is the most volatile. And when you hear volatile, what you should actually, the synonym for volatility inside of the investment community is opportunity. We have volatility, you have opportunity.
Interesting.
Yeah. So that's what an ETF is essentially. And the book was designed to, so for one, we reverse engineered that goal strategy right down to how do we actually achieve, or is it achievable, $1,000 to $1 million, right? And in a limited time frame, more importantly. That way we don't end up a millionaire when we're 88. Fantastic, we made it.
Yeah.
I can't take it to the grave with me.
The Warren Buffett method.
Yeah, precisely. Passive investment strategies, modern portfolio theory, all that stuff. So I built it, and once I had it, it actually wasn't a book in my mind. It was simply my own investment strategy. But I was applying this investment strategy to other people who were asking me about this. How can I achieve these goals? And I was like, well, fantastic. You ask, here's the strategy that I use. As these questions just kind of compounded, it became an idea to be a book that people could actually go and, capitalize on the exact same results that I did.
Right.
So anyway, that's the beginning of it. That's how it sort of fostered, and that's how I ended up in the situation.
Right. And now in our close circle, I know a lot of people rely on you or look to you for advice and interest on the market, but it sounds like there's a lot of people, you're getting a lot of phone calls right now. There's a lot of people interested in how the market's moving. Kind of like we briefed on in the intro with the new administration and the tariff policies, and then just social stigmas. I mean, Tesla's dropping like a tank because people hate Elon, right?
Precisely.
Right. So there's a lot of things going on which play into the volatility. But as you just mentioned, volatility is opportunity.
Absolutely.
So with what's going on, what opportunities, when you're getting these phone calls, like where are you kind of pushing people information-wise?
Yeah, so that's an excellent question, and it's a question that I've been asked 2-3 times a day, every single day for the last 10 days.
Yeah.
And
including from me.
And I kind of answer it like this. I kind of answer it in two ways, and I'll tackle the first one, and then I'll segue into the second one. The first one is, like, let's use your Tesla analogy. Do you believe Elon Musk is an intelligent person who's building a good company? Foundationally, Tesla is a good company, and in the future, it'll be worth more tomorrow than it is today.
I do, yeah.
Okay, fantastic. Under that premise, if you have a 50% pullback, which you currently do, if you're operating under that premise, you would essentially have an opportunity to buy Tesla at a discount.
Absolutely.
Okay, perfect. So that's the ideological construct on if there's buying opportunities right now. Yes, we've decided that Tesla is a good company, and I'm not saying that it is, but we've decided that it is in this conversation.
I'll take it as I'm saying that.
Okay, there you go. Fantastic.
When you have these types of conversations, it's easier if one person has a defined stance. And I do believe I'll stand behind that. I do think Tesla's a good company. I do believe in Elon Musk. So for this purpose, I'm your guy.
Okay, so Tesla, there you go.
Yep.
So in this particular situation, operating under the premise that it's a good company, it has good management, and its future prospects are positive, 50% pullback, that's an opportunity for you.
Right,
Volatility
absolutely.
is now opportunity. Okay.
And we're talking 50% pullback. Right before this market kind of started dwindling down, there was a huge uptick during, like right when the election happened, there was this huge positivity wave with Trump coming back into office. And then it started dropping. So are we talking 50% from kind of like its median growth range, or are we talking just from its highest, like a 52-week high?
So there's a really good question. That depends on how you want to price in the instrument. And that's one of the biggest arguments that stems across Wall Street. How do you price appropriately a stock, an ETF?
Right.
Super common one, PE ratios, price to earning ratios.
Okay.
I believe they're highly flawed. And you're like, okay, under what circumstance, if price to earning ratios are such a large metric to price in securities, would I have a stance to actually say that they're flawed? I'll give you an example. I believe it was either 2019 or 2017, so don't quote me on that, but Amazon had a quarterly report earnings where the earnings per share, which is how you calculate price to earnings ratios, your earnings per share was actually negative. It was negative 78 cents. The price of Amazon after that quarterly report, and you can look this up, this is all public knowledge, went on a 10 to 15% tirade after reporting a negative earnings. So if price to earnings ratio is an assignment that we can give to the appropriate price of securities, Why did it go up 15%?
Right.
Okay.
And I battle this one with myself because I'm not so in depth in the market, and I don't have quite like not even foundationally minuscule the education you have. But I found this out early in my trading just from watching social patterns. When someone reports a negative and the stock goes up, I was like, it threw me for a huge loop. And the only thing I came out of it with personally was the earnings call itself. So if you actually listen to the earnings call, and this is me, this is not, scientific by any means, but some of the companies I follow or invest in, when they have, say, even like a 10-cent drop on your P&E, but the earning call, everyone's very optimistic, that stock goes up. If they mention anything about like, well, we project that we might have a slower next quarter, or our product that we're calling our flagship for next year is going to be delayed, the word delay or slow or anything, dude, that 10-cent might have been $10, right? And then everyone just sells off. And it is a wild thing, the actual call itself. And if you guys haven't listened to the calls, you can go through your investment accounts, and there's a lot of open source. You can Google them and tune in. But that was what I took from it. Do you see the same trend as like how the company actually voices what their numbers say?
Yeah, absolutely. So and that has to do with investor sentiment, right? So investor sentiment drives markets, and it's not the markets always try to be predictive. So a lot of the price movement is generally baked in to what they feel is going to happen in the future. So for instance, tariffs are a really good example.
Yeah.
And I'll get on the tariff train here in just a little bit, but so that's the first part is that like the premise of it is that you've decided that Tesla is a good company.
Right.
Okay. So here's the second answer to that. The first one is always generally easy to answer. Like, do you believe that this is a good investment for the future? Maybe it's not immediately, but for the future.
Sure.
Here's the hard part. When I answer this question, when people call and ask me this, I generally answer it with a question. And the question typically is, what did you plan for? They don't typically have an answer.
Yeah.
So let me put this into an analogy that like maybe the viewers yourself will probably be able to ascribe to very easily. You play sports or have. Play football. Okay. Collegiate, Saturday game.
Correct.
Okay. So Saturday game, that's your go time for your execution in the stock market. Okay, that's what we're going to call it. How much preparation to your Saturday game would you put into the week leading up to that game?
The whole week.
The whole week.
Yeah.
Right? So how many hours total?
Oh, gosh.
35, including training.
So workouts, 2 hours a day, practice 2 hours a day, game film study another hour or two, so 5, 6, maybe even 7 hours a day.
Okay, so full-time job.
Yeah, 35, 40 hours easy, yeah.
For one game.
One game.
Okay. So you're researching your opponent, is that correct?
Yeah.
We call that, you call it film?
Game film study.
Okay, perfect. Yeah. So you're researching your opponent. You're researching your ETF, okay? When you arrive at your game, is defense?
I was on defense, yeah.
Okay. When you arrive at your game, would you make adjustments during your game to what your opponent did?
Absolutely.
Because you're prepared for it, right?
Right.
The exact same thing applies to investment strategies. You should be able to make adjustments over probable outcomes of what the stock, ETF, or instrument is doing. So basically what we see in the investment community, especially on the retail investment community, is people make decisions and then they develop strategies. Now, you wouldn't do it in any other area of your life, right? You wouldn't play a football game that way. Let's show up, hope for the best, and then if it doesn't work out, we'll start strategizing
we'll
when we
pivot where we need to.
What would happen if you did?
Oh, we'd get crushed every game.
Precisely.
Yeah.
Which is why people fail a lot in the investment community. So the best thing that you can do, my answer to their question is, what was your plan? They don't have a plan. You should have developed a plan beforehand. So that's the best way to kind of tackle that. In the event you don't have a plan, current volatility, how does it pertain to a plan if you don't have one? You should be looking for stock market pullbacks. Let's rewind just a little bit. We determined that Tesla is a good stock. You know what's better than Tesla is the entire market itself. You don't know if Tesla is going to rebound or continue to fall over any 10, 20 year period.
Right.
But what we do know with historical consistency over any 20-year period, the entire index has.
Right.
Okay. So if you build an investment framework over something that has always historically happened and build a strategy off of that, the probability of success significantly increases. Now, here's the problem.
Okay.
Okay.
I think you're about to say what I was going to say.
Okay. The problem, ask your question and let's see.
Well, I was just going to say, so when you take that approach, like the very long term, 20 plus years,
Yes.
right? And you're taking a big basket like the S&P,
Mm-hmm.
I mean, historically, you're guaranteed an uptick. The problem that I see in that is it's minuscule versus taking risk shorter term. So if I'm in Tesla and this rebound comes back and say it comes back to neutral, whatever, with that 50% backlash that we had. So it comes back to neutral. I'm taking a big uptick and pretty quick.
Yes.
But I'm also taking risk in the fact that it may never recover.
Also true.
Right. So in a 20-year strategy, maybe you get 12 to 20%. In a 6-month strategy where you're going a little riskier because you believe in a stock, you're taking a much bigger risk, losing everything or coming out net zero and wasting 6 months, however that looks. But there's a lot more upside. So how do you weigh those risks with your personal, like with me, I don't have, 10% of my investment strategy is not $1 million where I can, really pocket some cash and minimize my risk overall. Right. So for me, 10% is still 10%, but getting $300 versus $300,000 is a huge difference in people. So without rambling, like those long terms are very less enticing for people.
100%.
Yeah. And so you look at like the going more all in, put my eggs with Tesla because of history will tell me Tesla will recover.
Yes. So, and it's about 50% of what I was going to say. You're absolutely right. So let's shrink our time horizon and let's kind of war game this scenario. If you have an ETF, the problem with ETFs, right? So this is what I was going to sort of segue into. The problem with ETFs is that they're so overly diluted that the upside potential, like you just mentioned, is limited. So how do you have an instrument that moves in a much more subtle vector, right? Unlike Tesla,
Right.
which has I think it's like a 2.5 beta, which is extreme. Beta is relative to if you have the S&P 500 moves up $1 and all pricing is the same, Tesla would move up $2.50.
Right.
So it moves with 2.5 times the velocity. Okay. So
Basically self-leveraged.
yeah, precisely. And now there's a leveraged Tesla ETF. Go figure. So there's an ETF for it. Anyway, a derivative for derivatives. And so essentially what you have to do is, so the ETFs in the indexes are overly diluted. They're significantly diversified off so many different sectors, so many different stocks. One of the beauties is that they are diversified, and the other beauty of it, and on the risk limitation side, is that they are self-cleansing, right? So if a stock inside of the NASDAQ fails, it gets replaced with another one,
Right.
right? So we see that a lot when they do an induction for a new stock into that ETF.
Right. Because they're not just opening new slots. Someone
Right.
has to leave for someone else to get in.
Right.
Yeah.
Limited upside.
Trimming the fat.
Limited upside.
Yeah. Right,
Okay.
right.
So yeah, because we got Coca-Cola inside the same thing that we have Amazon. So
Yeah.
weighted averages pull that back. Anyway, so how do you increase the velocity of a safer blue chip type instrument? You add leverage to it. You increase the velocity and you turn up the volume, right?
Right.
That's what triple leveraged ETFs do, and double leveraged ETFs for that
Right.
matter. So shorten the time horizon. Because I know the viewers probably want an answer to where all this is going.
Yeah.
Like, this is all fantastic. It's all philosophical, but what is actual practical application for this? And here's the thing. If we shorten the time horizon, let's shrink it down to like 5 years. Okay, so we would let's just both agree under a theoretical standpoint that both Tesla and the NASDAQ are going to go up in 5 years. Okay? Forget administration, forget
Yeah.
economic,
All the
major
other BS, the
geopolitical
white
concerns.
noise. Yeah.
Let's just concede that it's going to go up.
Sure.
Before it goes up, what we would like it to do is go down. Why is that? Decreases in prices, just like we originally discussed, we decided that Tesla is a good company, allow for bargain shopping. Okay. So if we measure a triple leveraged ETF and we utilize what we would essentially call axiomatic probabilities, stock markets have to work inside specific frameworks and rules. Okay. So for instance, if you have a stock at $100 or an ETF at $100, what's the lowest it can go? Zero.
Yeah.
What's the highest it can go up? Infinity.
Infinite.
So we know the rules. Okay. We also know that we will function every single day, Monday through Friday, give or take holidays. And we also know that the CBOE has instituted limit up or limit downs for the ETFs. 5% goes up, we start tripping breakers. We saw that with the GameStop phenomenon. Turn this thing off because our people are losing money.
Right.
Okay, so that's another rule. If we have axiomatic probabilities that this instrument has to function under, we could essentially build mathematical systems around solving possibilities because now you have parameters.
Right.
So when you have parameters, you can come out with a spread of possible situations. So let's just war game this, okay? And I'm going to talk about the TQQQ specifically, and we'll just, if you want to use it for Tesla, if you want to use it for NVIDIA, you can apply it to anything.
Sure.
So we have $10,000 and we're non-exposed, which means we haven't purchased anything, right? Because Tesla comes up in a lot of conversations. If it pulled back 10%, what would you do?
Well,
For $10,000, what would you do?
I mean, with the knowledge I have now and
Yeah.
everything that we've talked about, if it dropped 10%, I would start watching it and game planning.
Cool. Okay. And if it dropped 20%, you would do the same thing.
That's when I would start pulling the trigger on putting money in,
Okay. And it dropped 30%.
put more money in.
Okay, cool. Fantastic. Are you putting more money in addition to what you've already invested, or more so it's a heavily weighted towards the bottom?
If I understand this right, so let's just say theoretically I put in 10% of, so I put in $1,000 when it hit that 20% mark.
Okay.
And then putting in more on top of this. So I'm not taking any of that out. I'm not touching that. I still have my $1,000.
Fantastic.
And then I'm adding, say, another 1,000 or even 2,000.
Yeah. That's dollar cost averaging. That's the entire premise of strategy one inside of that book.
Which I learned from you in that book.
Okay, fantastic. So that works. All right, we're getting through. And then one scenario, okay? Another scenario, it starts going up tomorrow. What's your strategy? Now I want to preface this. The strategies has to coexist. You have to be able to have a strategy for both possibilities.
Right.
Okay?
Right. Because we don't know one versus the other.
Yeah. We've already eliminated the possibility that it's a good investment. We've decided that. We've determined 5 years it's going to be higher than it is today. Okay. So it doesn't go down. It just starts going up. What's your strategy?
Depends on the percentage, I think. If I see, a consistent like 2% over a week, and it's still just going up, but it's like a gradual, I feel like that's a safer incline, and I would be willing to put in, say, 20%, because I'm still catching it relatively near the bottom, and it's not a spike. It's not visceral. I don't feel the volatility kicking me in the nuts and dropping off.
100%.
So if it's a smaller percentage, I feel like I'd put in a little heavier. If it's quick percentage, like 10% in a day, I'm not touching that. I'm going to start watching it every hour though to see what happens.
You ready for the answer?
Sure.
Get in same day. The moment you decide it's a good investment and it will be higher in 5 years than it is today, right?
Yeah.
Now it's time to buy.
Right.
Okay.
My mentality is probably, I think, too short term. I look for too much uptick quick. And that's what led me into that conclusion. But you're absolutely right. I mean, if it's a good deal now and you're willing to hold it for a period, you have the discipline to do so. Good deal now is a better deal later.
Yeah. So you've decided to take the field. You're going to go in zone defense, right? So you got your strategy. Your offense shifts to I formation. So now you go man. I'm not sure if those are applicable. You're probably thinking, no, that's absolutely wrong. That's not what I would do. But you're here. This changed, so you adjusted.
Sure.
Precisely. Okay, so you've already decided it's a good investment. So you have $10,000. So you're like, okay, on day of, execute $500. If it drops down, you want to favor your purchases as the fall begins. And one of the best things you can do is bracket in those price drops.
Yeah.
Okay. 10% pullback, 20% pullback, 30, 40, 50. Have a strategy for every single scenario. And also what I like to refer to as a 911. Like, what if this thing just takes total annihilation?
Yeah.
Having a super solid buy-in towards the bottom. In dollar cost averaging, how does that mitigate risk? It mitigates risk like this. If you buy at $100 and it goes down to $1, you're down 99%, right? If you buy in at $100, it goes down to $1 and you favor all of your weight towards the bottom of that $1, you're not out 99% because your dollar cost average is probably sitting somewhere around $1.50. So you're actually down 33%. See that?
Yeah.
You've shrunk your unrealized gains.
Right.
More importantly than that, if 100 was at all-time high, right? So for Tesla, I think it's 430, but don't quote me. If that all-time high is 100 and you own it at $1.50, what's now your short time horizon upside potential?
It's
massive.
Massive.
Right? So the solution is always have a plan. First off, decide if it's a relative investment that you want to actually engage in. And if it is, then if it's worth more tomorrow than it is today, you buy it today.
Right.
That's simple. The other is war game this situation. What if the offense shifts like this?
Mm-hmm.
What if, this receiver does that? I'd imagine there's a situation where a receiver heads this way and he gets traded off to maybe from a safety to a corner or a corner to a safety. That might happen. So you have to have plans in place. You should never have a situation, you will, and we all do, but you should never have a situation where you're investing and reacting. You should have an investment and a proactive strategy so you already know what to do when it in fact occurs.
And these are the things that you can, depending on the investment platform, you can actually build these in to happen automatically too. Is that
yes, correct.
So you can set your parameters. So say if we're focusing still on Tesla, I'm looking at, I don't know what was that? It was like 230 something today or whatever is in that ballpark. But say, let's just arbitrarily say it's at 250 and I'm like, hey, if it goes below 240, I'm gonna drop it in. I can actually schedule that out, right? And say, tell my investment portfolio, hey, if it hits 240 by X percent or X dollars, then if it keeps dropping, you can set those wickets and it'll keep buying for you. Do you think that that's a smart strategy? So you stick to your game plan, or do you feel like keeping the ability to pivot is a better play?
That's an excellent question. That question is as unique or is uniquely assigned to the investor itself.
Gotcha.
My answer to that is maybe.
Yeah.
But if I'm not certain, here's what I am certain about. Tesla drops to 230. You bracketed in your pricing percentages, right? What I would do is I would create a roof. So a lot of times what you're suggesting, a lot of times what is super commonly done is when it drops to this price, it triggers a buy. You call that a buy limit order. Okay. What I prefer to do, the term for that is called catching a falling knife. So the knife is falling and you're trying to grab it at the handle, but you might grab it at the blade.
Gotcha.
And it might keep going.
Right.
So what I choose to do is say, okay, Tesla's going to go 10, 20, 30, 40, 50% down. T-triple-Q is going to go 20, 40, 60, 80% down. Is to say, okay, when it does that, I'm not going to buy it, but I am going to put in a buy alert if it heads back up. What does that do? I'm not catching the falling knife. I'm waiting until the knife hits the ground to pick it up and grab it.
Right.
See what I mean?
Absolutely.
So it falls, it falls, it falls. It's not tripping these buy orders on the way down. What it's doing is it's falling, creating a price alert. If it heads back up, I'll buy it, because if it heads back up and we've defined bottom and it keeps going, it looks like I was smart enough to pick bottom. Well, I wasn't. I just trapped it is all I did. But let's say for that same scenario, it just keeps going down. Well, now I bracketed in those roofs. So let's play this out. $10,000, 10% on your initial trip, 20% on your second trip. So we have 1,000, 2,000, 30% on your other trip, which is 3,000, and then your final trip would be 4,000. So let's say it barrels through this guy, right? Gets down through all 4 rungs, heads back up, $4,000 initial buy-in, heads back up, hits the next rung, 3,000, 2,000, so on and so forth. What's your dollar cost average? Darn near rock bottom.
Yeah.
So if you look at this portfolio and you're like, okay, your average cost per share, this guy's brilliant. He timed bottom almost exactly within like 5%. Well, you didn't. You just strategized for the possibility is all you did, and then built an investment structure around it.
Gotcha. Which is tricky. And we had this conversation because what is the bottom? And I mean, it's impossible to know.
Impossible.
Right. There's so many variables. There's so many things going on in the market. And something we talked about that it kind of slowed me down is if you're looking at it from a daily point of view, you're going to be catching knives. Almost like you might get lucky, maybe, but your percentages, you're playing with fire on that one. If you look at it from a weekly point of view, you're doing okay. Like, but the if you can kind of get a better, and what I'm trying to say is if you go back, say 5 years in the market and you look at the dips, and then if you have the ability to scale and see how many days it was at certain dips, you can catch it within 5% in like a 2-3 week period sometimes, right? Very rarely is it on like, oh, the bottom happened this day and it never looked back, right? So I think when I was early in my investing strategy, would wait for like that day. I'd look for like the lowest point of that day, and that's the bottom. And I burned myself so many times. I had to slow down big time and really pump the brakes and be like, okay, it's been down for a week. And even if I miss the initial uptick, you scroll back 6 months, a year, 2 years, and people look at you like you're a genius because you hit the bottom, right? And maybe you missed it by 5, 6, 7%, but if it goes up pretty good, it's interesting what the bottom means.
Oh yeah.
From a daily perspective, you miss it every day.
Oh yeah. And so, and let me, if I may, kind of tackle that because that's a very common situation in what we'll just call entry-level investors. Is oh gosh, how would we say this? So it's really the solution that the TQQQ brings to these sort of consistent failures that we find ourselves in, and I'll explain. We're going out and we're trying to find the next NVIDIA. Yeah. Right?
Yeah.
And we need it today. We can't go back to 2003, right? So we're trying to find it today. So I'm going to blow your mind. Okay? Here we go. If we go back 20 years from the time that this book was published, which would be 2003, the price of the TQQQ in my retro applied price action that I did, because its genesis began in 2011, right? So that's inception was February 11th, 2011, I think. But anyway, so we had to build a price that didn't exist so we can determine how much it was worth. 2.86 cents is how much it was trading at. At the exact same time, NVIDIA was trading at approximately 6 cents, okay? So 2.5 pennies and 6 cents. You're trying to track down the next NVIDIA. You don't know what NVIDIA will do in a year if they're going to replace by another semiconductor company. I don't know. Right. Probably not, but you don't know. The TQQQ in that return time frame from its recent highest, which is just recently, right, $94, and NVIDIA's recent high, $153. It's running the figures just recently for a different portfolio I was working on for somebody. The TQQQ in that 20-year, 2003 to 2023, the TQQQ returned 404,000%.
Because of the leverage.
Precisely.
Yeah.
And NVIDIA, the next NVIDIA, right? So NVIDIA, I believe, was 304,000%. The TQQQ outperformed the number one semiconductor chip company, right?
Right.
Artificial intelligence. Okay.
It's easy to miss that because you just look dollar for dollar, and it's like, no, it went up way more than the TQQQ. Triple dollar for dollar. Right. But that's not what it equate to in money in your pocket.
So let's take back to our Tesla example. Do you think that NVIDIA is going to be worth more in 20 years from now than it is today? Yeah, I'd bank a lot of money on that.
For sure.
Don't go buy it. That's not my suggestion, but I'm just saying it without saying it.
Yeah.
But if I had to bet on the NASDAQ being higher versus NVIDIA, I would say 100% certainty, and here's why. The NASDAQ is diluted by other companies that will also be successful, and NVIDIA is in the NASDAQ.
Right.
So if it does go up, they have to go up in unison to some extent.
Sure.
With a weighted average. You no longer have to pick the stock anymore. You don't have to find the next NVIDIA because it already exists. We know what it is. It's a triple leveraged ETF with that. So the investigatory framework inside of this price to earnings ratio, earnings per share, caring about what the next 10Q quarterly report is going to say, the conference call, now becomes irrelevant.
Right.
And now you can focus on the things you need to focus on, which is your investment strategy. Make sense?
And and I was going to say that's your game plan, right? So then setting up within this strategy that you're building, right? Say it's the T triple Q. Within that, setting your buys and sell limits. So I know that was important because when we were looking at like it's going to fluctuate, and I remember talking to you about that. Like, well, hey, do I get rid of it at certain times? Do I buy in and kind of time it out, or do I just buy and hold? And there's been a lot of stigma around ETFs that you don't buy and hold them. Some of the great feedback that's come back on this book, specifically through like the Amazon reviews of people who have picked it up and review your book, have been like, hey. For a long time, people have said, do not buy and hold, but this proves you can. You're just going to weather some storms, but either way, you're going to, the historics say you're going to gain at a triple leverage price. So it's very interesting to, I guess, it's easier just to buy in and let it ride.
Yes.
It takes more time, more dedication to set your metrics. But how do you, in a triple leverage, because if you look at it, 1 equals 3, right? Just arbitrarily, 1 equals 3. Well, that also happens on the way down.
Correct.
So if you can minimize your downswings, do you play it kind of the same as if you would if you're just buying a solo stock, like we just talked about? Set your percentages and do your sell orders the same as you would, like say, your buy orders.
Yeah, so that's the more specific and slightly more complicated version than the simplest approach that I wanted to take. So I wanted to build complexity tranches into the book. I wanted to start out with basically it's like the most fundamental concept that there is. Buy every quarter.
Right.
Super simple. When I mathed it out, so the first thing that we have to do to kind of answer this question is I bought into the stigma of the triple leveraged ETF investment strategy from all the professionals, if you will, too. One was decay rate or theta decay. Time decay, which is that it has an expense ratio and that eats away at your profitability. Well, that's offset by dividends, so we can eliminate that. And number two, if I charged you 1% a year to get to 404,000%, would you care? Okay, fantastic. Deal. So let's conquer that. And then the other is precipitous drops, right? So that's probably the primary argument, which is why you cannot just buy and hold. You have to do continual contributions if you're going to hold for a long time horizon, right? Because the probability, you got 27 bear markets over the period of 100 years, 1928 all the way to current, right? 27 bear markets. Half of those occurred between 1928 and 1945. That's crazy, right?
Yeah.
Why are bear markets decreasing over a period? Well, there's a couple of reasons. Government and Federal Reserve intervention, right? Now we have some levers we can pull to change the economic outcomes. And number two is investment contributions. People like you didn't have access to these things all the way back in. So now there's more opportunities to buy. Okay.
And unfortunately, just like that, folks, the episode is over. Like I stated in the intro, unfortunately, we lost audio right here. We were excited to get this portion out, irregardless of how it ended. So thank you for bearing with us. Hopefully you got something out of this episode. I know Brandon and I did. We had a great time talking, and we're going to do a longer episode coming up here shortly. But if you took something out of this, please share it. I know it's not a great representation of my editing and production skills, but the information is there. If you are curious about reading further about what BD put out in his book, all the links are all over my social medias. You can find it on Instagram. If you look in my link tree, I'll put the link at the bottom in the description of the Apple, Spotify, or YouTube, however you're tuning in. But I encourage you, please, go check it out, read the book, expand your horizons, and just get a better understanding of one more option that you have in the financial realm if you so choose. But thank you to Brandon, and thank you guys for tuning in, and I will see you next time on Warrior Enigma.